method is preferred. It tends to be more accurate. It is just more prevalent in practice. It's a two-step balance. And this is so important you understand the difference, because students will often misinterpret it as a one-step process. So the first thing I do, notice in the income statement approach, or the percentage of sales approach, my percent multiplied by my revenue gave me bad debt expense directly. What I'm getting now is the ending balance of ADA. So I'm no longer predicting an expense with my percent. I'm predicting an asset balance, actually a contra asset balance. And the way I'm doing that is using an asset balance and multiplying it by a historical trend from company data. So the company says, right, I look at the total amount of receivables I have at the end of any period, and it tends to be that, whatever, 4% of that total balance are going to be bad debt. So in that case, what's happening is I'm going away from those income statement accounts and using the balance of this account to predict the adjusted balance of this account. That is not bad debt expense, right? Bad debt expense precedes this balance. So then we calculate bad debt expense after we have this resulting balance. Bad debt expense for the period is whatever adjustment we need to make to obtain this balance here. So the example I give is basically the same example, except that I just changed the amount of the estimate that we think is going to be bad. So we still have an accounts receivable account that's going to balance out after I begin with a $20 balance. I have $70 of credit sales. I collect 77. I write off a $4 account. And then I have ADA that's going to have a $3 beginning balance, $4 write-off, and prior to adjustment, have that $1 balance. This still gives me $9. And I'm going to now apply my estimation technique. My estimation technique tells me that 15% of my accounts receivable result in bad debt. So this number is being used to predict this balance here. 9 times 15% is 1 point something. Let me see. $1.35. But that, remember, this is not my bad debt expense. This is the balance of my ADA account. My bad debt expense is the adjustment I need to make here in order to go from a $1 debit balance to a $135 credit balance. And that would be $2.35, because I have to reset this to 0. I need to take out this debit balance, zero it out, and then I have to add $1.35. So $1 plus $1.35 gives me the amount that's missing. My bad debt expense and my ADA would be for $2.35. So part of the reason why this is so much more accurate is that because of the two-step process, because I predict the final result and then back into, well, what is my bad debt expense going to be? It's taking into account where the balance of ADA is prior to adjusting it. So, for example, if this were, instead of $1 underestimated, if it had been $10 of an underestimate, right? I underestimated my bad debts in a prior period, then this current estimate would be up. It would go from $2.35 up to $11.35 if I have a desired balance of $1.35. So it adjusts for any under or overestimate that happened during the period based on what I predicted would be bad debt in the prior period, right? This $3 came from the estimate I made in the prior period. In this case, it ended up being an underestimate by $1. But if it had been an underestimate by $10, well, then my bad debt expense will make up for that this period and say, well, crap, didn't have enough. I need to report a little bit more bad debt expense this period to make up for that shortage in the estimate. Over here, when I did the income statement method, I didn't care what was here. I didn't care that it was $1 or $10. It would have, this estimate would have stayed the same because it's not based on my AR or my ADA. It's just based on two income statement accounts. All right. Another reason why this is so accurate is that we can use what we call an aging schedule in order to determine in order to get a better idea and assign the percentages. And so rather than just, for example, assign a flat 15% here, what the aging schedule would do is list out the $9 of accounts, like maybe one of those, a majority of those accounts, we'll say $5 of them are 1 to 30 days, and 3 of them are 30 to 60, and 1 of them is 60 plus days outstanding. Now we can be more granular, more precise with assigning, all right, I think the ones that are, the probability of default is going to be much less for the 1 to 30 days. And I have records that say, whatever, only 10% of those will default versus 20% of the 30 to 60 days will default. And then 50% of the 60 plus days will default. So we can get a little bit more detailed with our likelihood of default when we can break out, okay, of this outstanding number, how long has each dollar value been outstanding for? The longer something's outstanding, all things equal, the less likely you are to be able to collect from that customer. So that is the balance sheet method versus the income statement method. And like I said, you really need to know the differences between them, the advantages of the balance sheet method, how it works differently than the income statement method, and be able to answer questions along those lines, in addition to being able to work with it to find bad debt expense under either method. Any questions about that part?